Hello and welcome. My name is Warren Poe, and thank you for joining us for the CI Brightworth second quarter market commentary. Today I'm joined by Chief Investment Officer Don Wilson and Portfolio Manager John Darby. In today's video, we're going to talk about three topics that we know are pressing on our clients' minds. First, the recessionary pressures facing the economy and what that means for our clients' accounts. Secondly, inflation and both what the outlook is in the short term and the long run. Thirdly, we'll discuss the bond market, which is off to a historically bad start this year, and what that looks like going forward. And finally, John is going to wrap us up by talking about what we're doing in our clients' accounts, and most importantly, what we're not doing. So with that, gentlemen, I'll let you take it away.
It's been a difficult start to the market, both for stocks and bonds. But before we zoom in on year-to-date and quarterly results, let's zoom out for just a little bit and talk about what's taken place in the S&P 500 the last several years. In 2019, the S&P 500 was up 31%. 2020, it was up another 18%. And in 2021, it rose another 29%. So keep that in mind as we look at what's taking place today. So year to date, the S&P 500 down 20%. So it's an official bear market. And it's given back some of these very strong gains that have taken place the last 3 years. If we look out across some of the other asset classes, it's been a similarly difficult environment. Take a look at this chart. You can see small caps down 19%, international 18%, and even bonds, this may be the more surprising part, long government bonds 22%, the core bonds 10%, and high yield bonds down 14%. And a lot of this has taken place in the second quarter. You can see those numbers on the left-hand side. Now, for investors of stock, they may not be that surprised with this pullback that we've seen in stocks so far year to date, especially given the strong performance that we've seen in recent years. Bonds are probably more surprising. And in fact, this has been the worst beginning of the year, worst half of a year since the broad bond market index started back in 1977. So that, I think, deserves a little extra time. We're going to actually take another segment and focus on that. But for now, let's talk about a little bit of some of the other things that are going on kind of underneath the surface in the stock market. One of the things that we see is that U.S. stocks actually underperformed international stocks in the second quarter. And that's very unusual, very different from what we've been seeing for the last decade. And if you take a look at this chart shows U.S. versus international stocks, and that's the orange line. When it's rising, U.S. stocks are outperforming. When the blue line is rising, international stocks are outperforming. What you see is for well over a decade, international stocks have been crushed by U.S. stocks. We started to see that change in the second quarter. Too early to tell if that's going to continue, but something that we'll be watching. Likewise, very similar between growth and value stocks. Growth stocks have strongly outperformed value stocks for well over a decade, until now. Year to date, we've seen value stocks actually hold up significantly better than growth stocks. And you can see that on this chart. The growth stocks in blue, the value stocks outperforming when they rise on the orange line. And so strong outperformance for growth for well over a decade, but value has really turned it on and is holding up better here year to date. So again, something we'll be watching to see if this continues. If we zoom in on some of the really highest flying stocks in the growth sector, some of the best performers in recent years, we see that those stocks have had a really, really difficult time. And take a look at this chart. This chart shows a lot of the new economy stocks. Companies you're familiar with like Meta and Uber and Zoom and Netflix. And these stocks are down 57, 68, 75%. Even Rivian, 85%, an electric vehicle maker. Peloton, 93%. Carvana, 94%. So just really, really tremendous declines from their all-time highs previously. In fact, a number of these stocks have now recently been reclassified by Russell. They're no longer growth stocks because of these strong declines. They're now classified as value stocks. So there's been a lot of volatility going on underneath the surface of the stock market. Lots of stocks down 40, 50, and more percent, as you can see from some of these. For investors, it's being able to endure this kind of volatility that you are rewarded in the long time for. And so when we look at the S&P 500, despite the fact it's down 20% year to date, despite the fact that over the last decade it's been down that much and more several times, the S&P 500 has delivered double-digit returns on an annualized basis over the last 3, 5, and 10-year time periods. And that's what investors are willing to take the volatility to achieve that reward. So John, with that, talk to us about recession.
Yeah, I think that's the main question we've been getting lately, Don, is are we in a recession already or are we about to enter a recession? And all the economic data would suggest that economic activity is indeed slowing down, but at the same time, unemployment is not only very low, but still dropping, which would be very unusual in a recession. But either way, I want to reframe the question and illustrate why it probably doesn't matter as much as you may think. So when people ask, are we in a recession? Are we headed for one? I think the real question behind that is, do I need to change my investment strategy? Is the market about to crash? And believe it or not, identifying or timing a recession doesn't really help that very much. It doesn't help answer that. So to start, even defining a recession is not that straightforward. The original definition was 2 declining quarters of real GDP, so negative GDP growth for 2 quarters in a row. But then more recently, the NBER, which is the group that officially gets to declare recessions, they've come up with a more kind of vague, subjective definition. But whichever one you use, you don't find out until well after the fact. And so let's go over a couple examples here to show how that played out, because not only do you see you don't know recessions until well after, but the stock market doesn't always correspond how you may think. So for example, take the last recession we had at the beginning of 2020 with COVID. It only lasted 2 months, very, very short. And by the time it was announced that a recession had begun, it was also announced that it ended several months ago, and the stock market had bottomed and then recovered at that point. So it all happened very quickly. But to contrast that, in the early 2000s, the unwinding of the tech bubble, there was a recession in the middle of 2001. However, the stock market had already declined 18% before the recession started. It was only down 7% during the actual recession, but then following that, it was down another 29% after the recession. So even if you had timed the recession part perfectly, it probably wouldn't have helped from an investment standpoint. I want to show this chart to continue to illustrate this point. So this shows stock market returns 6 months before a recession, during the recession, and then several periods after the recession. And what may surprise you if you look towards the center there and look at the returns during the actual recession, so this is the last 12 recessions in the US, and half the returns are positive. So 6 out of 12 times we had positive returns during a recession. So it just goes to show the market is unpredictable and doesn't always correspond to the economic data. What's more important, I think, in this table, though, is if you look out to the right at the longer term returns, you see that everything's positive and most of the returns are quite high. And so that's why we always point to the big picture, to long-term investment strategies, because whether you invest before, during, or after a recession, if you stay the course and invest with a long time horizon, the results are usually pretty good. So when it comes down to it, identifying or timing a recession really doesn't help you much from an investment standpoint, which brings up another point. A word we've been hearing a lot lately is uncertainty. We're in a very uncertain time. There's a lot of economic or geopolitical uncertainty. And we certainly wouldn't argue with that, but that's always the case. We're always in a period of uncertainty. There may be some issues right now that are unique to this period, but if you look back in history, even during the most stable markets, the strongest economies, if you look back at headlines during those periods, it'll seem like the world is just chaos and there's all sorts of risks. And there's always risks, but some may not materialize or the market may do well in spite of those risks. But there's only certainty in hindsight, never in the moment. And so rather than trying to become more certain about things that are simply unknowable or unpredictable, our approach is to accept, even embrace that uncertainty. And like Don said earlier, you don't get any reward without the risk. So you have to be willing to take some risk, accept some volatility, and that's how you get rewarded with those long-term returns. So with that said, Don, another topic that is top of mind for most investors is inflation. So talk to us about inflation.
Yeah, it definitely is. And when we think about the factors that have a big impact on inflation, two of those are supply and demand. Economics 101 teaches us that if you have more supply and lower demand, prices are going to come down. Reversely or conversely, if you have a lot of demand and not as much supply, prices are going to go up. Rewind back to 2020. The global pandemic really hit both supply and demand hard. We saw thousands of businesses and plants and manufacturers shut down, all hitting the supply side. On the demand side, we had millions of people who lost their jobs, lost their income, and therefore that had a huge impact, negative impact on demand. Now, governments around the world, including the US, poured a lot, trillions of dollars of stimulus into the system. And that had a huge impact on demand. People were able to buy things. They were able to continue to live even though they had lost their jobs. So demand has been doing very well. It has recovered strongly. Supply, however, has really continued to struggle as you've got shortages, you've got labor shortages, you've got, on top of that, it's been exacerbated by Russia's invasion of Ukraine, which has also caused shortages of energy and food commodities, agricultural commodities. So that's kind of where we are today. Demand has recovered well, supply is still really challenged, and that's why we're seeing inflation. Now, when we think about inflation, it's important that it's not just about high prices. It's also about prices continuing to go up. A good example of that is thinking about the price of a gallon of gasoline. Take a look at this chart. A year ago, a gallon of gas cost about $3.40. Energy and gas prices have gone up a lot. So today, it's about $5 a gallon, almost 50% higher. Now, if a year from now, a price of a gallon of gas is still $5 a gallon, that will actually not increase inflation. That will actually make inflation go lower because there won't be any increase in the price. For inflation to continue to go higher, the price of the gallon of gas would, at the same trajectory, would need to go up to $7.50 a gallon. So, as we think about inflation, we don't think that's the most likely scenario. We do think that gasoline prices and other prices are likely to moderate, as high prices, in a sense, are a cure for themselves. Of course, the Federal Reserve is also working hard to bring inflation down. And as we talked about, there's really two sides to this. There's supply and demand. There's not a lot they can do to help the supply side. And so what they're doing, the tools they use, really help to focus on demand. What they do is they're raising the short-term interest rates. And that trickles through to rates for consumers on things like mortgages, on car payments, on credit card interest rates. And as those go higher, that forces the demand down as it's more expensive to buy a car, it's more expensive to buy something on credit, or more expensive to buy a house. That's going to push demand down. Same for companies. Companies now taking out loans, it will be more expensive to do so, and so they're going to be less inclined to do that. So we do expect inflation to improve, to moderate, because of improvements on the supply side that will take place, as well as demand coming down in response to some higher interest rates. However, before we see that improvement, it's likely that the CPI numbers that get reported each month will go up instead of down. And to understand why that is, take a look at this chart. The annual 12-month CPI number, which was just reported as 8.6%, is made up of 12 underlying monthly CPI numbers. Every month, the oldest one falls off and a new one is added. And as we look at these numbers, we don't know what the new ones are going to be, but we know the ones that are going to be coming off. And so we can see June of 2021, which will come off when June of 2022 is added, was 0.9%. That's pretty high, so it probably means that the new number won't be, if anything, much higher than that, so inflation will not probably go up much. The more challenging time is for the months of July, August, and September, when the numbers are 0.5, 0.2, and 0.3. Those are pretty low numbers. So if we see higher inflation numbers, which seems likely, when those numbers fall off and new ones come on, we probably will see the CPI number rise in the months ahead. So in the months ahead, inflation, at least reported inflation, will probably keep going up. Long term, however, we do expect inflation to come down for what the Fed is doing to work, as well as for supply chains to improve.
So Don, another topic of interest lately is bonds. You mentioned earlier it's been a historically bad start to the year for bonds. So what's going on in the bond market?
Well, it is the worst year for core bonds going back all the way to the index's inception in 1977. Take a look at this chart, and I think this helps us to see this visually. This chart shows the path of the return for the broad U.S. bond market over the years going back all the way to 1977. So each of those gray lines is the return over time for a different year. What you see, the purple line is for 2022, and it's well below any of the other years at this point in the year. So we've got not only the worst year on record for bonds, but by a wide margin. So let's talk about that. Let's talk about why that is the case. When we're talking about the investment grade bond returns, there's really two things that have a big impact on their returns. First is their starting yield, and the second thing is the change in yield over the time period. So we started the year, and take a look at this chart, and you can see for several different parts of the bond market, the U.S. aggregate bond, which is the broad bond market, treasuries, the 5-year treasury, and then for muni bonds, starting yields of 1.7, 1.3%, and 1.7%. So we started with very low yields. But then look at how much they rose over the last 6 months. We saw the U.S. aggregate index almost double, up 1.6%. 5-year treasuries more than doubled, up 1.75%. Muni bonds up 1.1%. So we started with very low yields. We had a very sharp increase, very big increase in yields over the 6-month time period. And that is what has led to a very poor year, or very poor 6 months for bonds. Now we've got a lot of people who say, well, the Federal Reserve is still raising rates. Won't that mean that bonds' second half of the year will be just like the first half? And I think there's a couple things to keep in mind. First, the Federal Reserve is changing the very shortest maturity bonds. They're setting the federal funds rate, which is essentially very, very short maturity bonds. It's the market and investors who are setting the yields for 2 and 3 and 5 and 10 and 30-year maturity bonds. So when the Federal Reserve has been talking about raising interest rates and talking about their plans to continue to raise rates for the rest of the year, investors in the bond market don't wait for that to take place to adjust the prices on these bonds. They go ahead and do it. And so for many cases, we think it's likely that bonds have already priced in these interest rate increases that the Fed is planning to do. If they haven't fully priced it in, they've gone a long way towards doing that. So when we look at the situation for bonds from here, it's a very different situation today than it was at the beginning of the year. First, interest rates are much higher. So you're going to have a cushion from that income if rates rise further. Second, the bond market and investors have already anticipated what the Federal Reserve is planning to do, and they've priced that into bonds. And so from here, we think that bonds are in a much better position. Higher rates, and they have already anticipated what the Fed is planning to do. So that puts them in a much different position, a much different and better place from here. John, with that, talk to us about what are some of the things we're doing in client portfolios?
So there's several things we're doing in our clients' portfolios, but what's probably even more important is what we're not doing. So let's start there. We're not panicking. We're not making emotional or impulsive decisions. In our business, we have a term we call the big mistake. And the big mistake is when a client panics when the market is falling and they just sell out of everything, get out of the market altogether and just hold cash. And we call it that for a reason. I was talking to a big group of advisors the other day, and we were talking about this. So I asked, has anyone ever had a client who made the big mistake, but they actually came out ahead? They benefited from it. And every single advisor said no, they've never had someone actually benefit from doing this. And I think the reason is, if you sell out of the market, you have to get back in the market eventually. And markets tend to bottom before the dust settles. There can often be sharp, unexpected rebounds before things look better. So to get back in, you would have to invest at a time when things still look pretty rough, and that's extremely rare. So we want to be proactive rather than reactive. We have a disciplined investment process that we stick to. You know, Don, you brought up the high-flying stocks, the new economy stocks earlier and how much they had fallen. You know, a lot of investors had really loaded up on those. And so if you're looking at 60, 70, 80% losses, they're scrambling, wondering what to do next. And, you know, we don't have that issue. Some things we are doing in clients' portfolios, when the market's down, that creates opportunity to implement some tax strategies. So we are actively looking for opportunities to help you save money on your next tax bill. We also have a systematic investment process that is designed to take advantage of market volatility. So when different parts of your portfolio move in different directions, we will effectively sell high and buy low. So you may see us trade in your accounts because of that or for other reasons. But what you may not see that's also going on under the hood is actively managed funds. So if you have actively managed funds in your account, then there's an investment team, an investment manager who is constantly looking at risks and opportunities in the market and repositioning that fund to take advantage of the volatility. So you may not see that, but know it's going on under the hood. So to wrap it all up, the bottom line is we're staying disciplined, we're adjusting your portfolio to keep it on target, we're looking for opportunities to save on taxes, and we're here to help you navigate this market volatility and stay on track.
Thank you, Don and John, for your time and thoughts on the markets and the economy as a whole today. We hope you've enjoyed this video and found it beneficial. If you have any additional questions or concerns, please feel free to reach out to your advisor, and we'd love to continue the conversation offline. We look forward to seeing you again next quarter. Thank you.